Welcome to the show, Grads and Patri. Thanks for coming here.
Thanks for having me. Excited to have a conversation today.
Thanks, Nish, for inviting me again. I'm happy to be with you, Grads.
You too, Patrick.
Our audience will recognize Patricius from the last two episodes of Season 1, the Encyclopedia of Fitness and the Encyclopedia of Health and Wellness. I must say, these were the most informative episode of entire Season 1. So I'm excited. What do you bring on the table for DeFi this time?
Yeah, it should be a great conversation today. I mean, there's a lot of, the crypto metaverse is real. The pace of innovation is exponentially expansive, and there's no topics, there's no short amount of topics that we can get into today.
That's very true. It's such this space is expanding so fast. It's so hard to keep a track of. I've been trying to, tiptoe my way into it, but still, it's very hard. Even if you give a lot of time, things are moving so quickly. So let's hope we'll cover the basics of DeFi first. So before delving into the good stuff, the deep stuff, let's start off with something basic. The fundamental need for DeFi. So we need DeFi. DeFi stands for decentralized finance. So we need decentralized finance obviously because there are some problems with the existing model, that is centralized finance. So I'd like you all to explain to the audience what's wrong with centralized finance. First off, let's differentiate between centralized and decentralized. What say? Who wants to go first?
I could take a shot at it. So DeFi or decentralized finance is just a term that encapsulates an umbrella term of financial services on public blockchains, primarily Ethereum. With DeFi, you can do most of the things that banks support today: earn interest, borrow, lend, buy insurance, trade derivatives, trade assets, and more. But it's faster and doesn't require paperwork of a trusted third party. So people in crypto generally, DeFi is kind of a global peer-to-peer, pseudonymous and open to all ecosystem.
Okay, that's pretty interesting. One thing I'd like to add here that the existing bank model. So banks earn as they give out loans, and so they get some interest from it, and then they pay some amount to the people who have deposited their money. So the difference in the interest is their profit. When it comes to DeFi, if you are borrowing something, you'll get it at a much cheaper rate of interest. And if you're lending something, you'll get much higher rate of interest. Because essentially there is no third party institution in between who needs to take their profits. So it makes the transaction pretty seamless. This is one thing that, the mainstream is ignoring.
Yeah, definitely. I mean, looking at the positives from my perspective and, working within the ecosystem, trying to understand, to get my feet around, what did the traditional finance models look like? How was money being made? What's the importance of velocity of money, especially in a decentralized digital economy? And then also, how does crypto native technologies, make it more efficient, more value for all the participants within the network? So, from my perspective, the pros when I'm looking at it is it's open, so you don't need that trusted third party. You as a sovereign individual have the ability to take on and cure risk, but also the reward that comes with the risk. It's pseudonymous, so you don't have to provide your name. That's actually changing. If you look at institutional governance models that are being implemented that I think moving forward are going to be a key requirement, because governments aren't going to stop crypto, but they are going to tax it, right? And building institutional custody models, banks, payment providers within the space, you have to stay legally compliant. So that's something that's not changing, but I don't think it's necessarily a bad thing if we get to play as being first adopters. When I look at other benefits, it's flexible. So you can move your assets anywhere at any time without asking permission, waiting for long transfers to finish or pay expensive fees. And it's faster. The interest rates and rewards often update rapidly, as quickly as like 15 seconds, and you could be significantly higher than traditional Wall Street. Also, there's a piece that makes it transparent. Everyone involved can kind of see the full set of transactions, so you get to have more visibility of on-chain analytics. And I'll do the downsides as I want to call it out, because it's not 100% perfect, but that comes with innovation, and more problems means more solutions that are going to be solved by the market. But when I'm looking at the downsides right now, just what I'm seeing from my perspective is fluctuating kind of transaction rates on the ETH blockchain can mean that active trading can get expensive. Depending on which dApp you use and how you use them, your investment could experience high volatility. If you've been in the space, you're probably used to this. And then you also, like, one of the biggest downsides as the ecosystems and the blockchains just expansively grow and then also interoperate is you have to maintain your own records for tax purposes. And regulations can vary region to region.
You just mentioned dApps. The audience who don't know what dApps are, I think it's decentralized applications, and we'll cover them later. It's a bit of the advanced stuff. It's the application of DeFi. So we'll get into that later. So, Graz, how do you think this tax thing will actually work? So, for example, I'll give you a scenario. I've been holding Ethereum, for example, on my hardware wallet, and it's been growing in value. So, most likely, the way I think that government can tax it is when I withdraw it for fiat currency. So what if I take small proportions of my assets and withdraw them according to my need? Government doesn't need to know my entire asset evaluation. So how will they get through this?
I mean, you can use Etherscan. There's companies like CipherTrace that provide on-chain analytics that the US government works with. So there's definitely ways that are being utilized today and technology companies that are in place today to help the IRS, find transactions, right? So using AI, using non-language pattern recognition, and there's a couple other technologies that help with these on-chain analytics. So the taxation, from my perspective, is if you buy crypto with fiat, you're all right if you're holding it. If it's in an interest-bearing account, other than like a ledger, say you're not making anything on the ledger, just the undervalue or the value of the asset of ETH as it goes up, you don't have to pay. But if you're in something like BlockFi, which is a centralized finance way to bear an APY, you're going to have to pay. You're going to have to report and pay the interest being made. And the other one is anytime you transact either crypto to crypto or crypto back to fiat is considered a taxable event.
Yeah, so it's important to check with your country's regulations because it varies from country to country. Because I believe Portugal has zero of that. Zero taxation. Yeah, exactly. Some guys are luckier.
Right. Yeah, I mean, you see a mass exodus from the U.S. to Dubai to Puerto Rico, which has tax advantages in that regard. But yeah, definitely look at your country's region. It's definitely something to take into account from a risk perspective and the volume of transactions compared to what you can pay. I won't recommend this. There are ways to tax harvest if you're in high taxable countries where, say, you bought Bitcoin, you knew Bitcoin was going up by the end of the year, which I think I'm a firm believer of as we rocket ship up the next 3 months. If you bought it at 50 and then you sold it at 30 and waited, I believe it's a month, and you bought back in, then that's considered a capital gains loss. So there's definitely tax strategies, just like in the stock market, that people can implement, and I would just say go research online, for your country if you think that might be a problem in the future.
Definitely. These are some good points. Read the regulations. Because I think Binance very recently suspended futures trading in some European countries. And the people were unaware of it. They had some positions opened and they're stuck. So yeah, read your regulations. So I think I'll come back to the earlier question that I asked. What's wrong with the current financial system? We just discussed the good things about DeFi. But what's wrong with the centralized finance system?
You want to take this, Patricia?
Well, yeah, I'm gonna say, I'm a newbie. But I did my research. I find, in simple terms for guys that are new, the way I see it is that they lost control. They lost accountability. They lost control. Their debt to GDP ratio is absurd. And I think, I'm not sure the percentage, I have trouble retaining this one, but I think once they passed 80% of their total debt to GDP ratio for a country, it's impossible to come back, I believe. Grads, is it around 80%?
Yeah.
What do you think?
Yeah, it's higher.
Or 100?
Yeah.
Okay. Yeah, so like you got a bunch of countries that like they're at above a certain total debt to GDP ratio, which is absurd. And I also been listening to another podcast with Robert Breedlove, and the individual who was talking was saying, even if you tax everyone for the year, 100%, companies, everyone, they cannot pay off the debt. So I listen to all this, and all I come to senses is like, there's no way out. So it's going to the grave. I don't know. Maybe they might find a way out, but I don't see a way out. It's absurd. And now with COVID, they keep printing, and then there's another Twitter feed I see that they're gonna mint $1 trillion platinum coin or something. It's getting ridiculous. It's like I find that a joke. Like, it's a joke. They're just gonna mint one coin and that's the value of $1 trillion because you say so. Like, nothing makes sense to me anymore. Like, so I'm sort of like, okay. So I don't know what the end game result is, but I don't think the end game result is good. Do you have anything to add, Gratz? But basically, in simple terms, that's what I see, man. Around the world, globally.
Yeah, the United States is literally clown world right now. There's this website called usdebtclock.org.
I'm familiar.
this. I've opened this right now. Yeah, it's a clock, an ever increasing database of what is the current US national debt. So as of now, at the time of recording, it's $28.8 trillion. So the debt per citizen is $86,000.
86, holy shit.
$228,000 per taxpayer.
Yep.
Oh man, so, it used to be a lot less last time I checked it. Jeez.
Yeah.
Yeah.
Yeah, once you understand, here's my come up is like, I'm from a small town in Canada originally, but a suitcase, lived in 8 different cities, got involved in the crypto market, 2019 before it really took off on its latest cycle. And all these questions come up when you start learning about Bitcoin first, right? Or crypto first. You start with Bitcoin and you go down the rabbit hole, and then you start looking at the history of money, and you start asking questions like, what is value? Why does the society value currency? What is currency? You start asking all these questions, and then you start looking at things of how the money's not pegged to anything, but it's just, an instrument of debt, right? $1 is one debt instrument. And then you start looking at, current debts around the world and strategies that governments have used historically throughout cycles of inflating the debt away at the end of a currency era. And I think currencies historically have 80 to 100 year life cycles before they crash. Every fiat currency has crashed. And, from my perspective, we're at the end of that cycle that's getting prolonged, and we're in that inflationary print your way out, inflate the debt away phase. And I think since me being brought up in school, like, this type of finance I was never educated upon, and I think most people are unaware. Crypto looks like a Ponzi scheme from the outside in until you understand how the current system is set up to fail.
This is definitely true. The first time I discovered crypto, when I first understood how does this thing work, what is the need for it, while I was entering the rabbit hole, I was shocked. I was questioning the reality. What I was taught, that the safest way to place your money, it's in the banks and all that stuff. I was excited that banks give me 3% interest on my money. Wow, that's crazy. It's so good. Now the reality has come crashing down when you see the returns on D-apps. It's really crazy. Now imagine being an average person in USA, and when you see the statistics, you're obliged to pay $86,000 for something that is not even done by you. You have no part in this. Also, you just mentioned about the end of the cycle. So yeah, US has a debt ceiling, I believe. Do you have any idea what will happen? I've just heard about this debt ceiling.
They can't, it's mathematically impossible to continue to pay the interest on the debt. They can't lower the debt ceiling. That's the catch-22.
Okay, so basically it's the point of no return.
Yeah, and that's why you see people taking on more and more risk within the market. You see it in pricing of everything, the inflation of assets everywhere, from stocks, bonds, commodities, housing. It all goes up, right? I don't know if we're in 1929 currently. I don't know what year we're in, but we're definitely in that. We've been in that phase over the last year and a half, because looking at the way March 2020, when everything crashed, and how it responded, even though we were in a global pandemic. And, here in the US, at least, people are getting laid off due to COVID. People are in kind of existential crises, I think, and kind of nihilistic, and not going to find work. And we have valuations of companies just continuing to go up. And it, I think Definitely. It all goes back to lack of sound money, right? It's just money being stored because, the Wolves of Wall Street know it needs to find a hoe to gain APY, and they're just taking advantage of the current cycle. I think if most people knew that,
it's not just the US market.
It's not. It's globally. Yeah.
Yeah, exactly. Because the Indian stock market. So, how you guys have S&P 500, we have our index of our stock market. It's called Sensex and Nifty, and these indexes are at an all-time high.
Sensex.
Yeah, they are at an all-time high,
which makes no sense.
Literally, the entire system is on the verge of collapse.
Yeah, we had a pandemic. They're printing money, and it's an all-time high. That makes no. It's illogical. But I like a lot of people don't make sense.
I was gonna say I looked at it from how you guys are looking at it right now, but I also had the benefit. So, in 2019, I was working for, a well-renowned multi-party computation cryptography company that was providing solutions of custody services as a custody tech provider. So competitors like Curve, Fireblocks, we were, competing with and going after crypto native companies and, crypto wallet companies, crypto exchanges, crypto custodians, and then also tier 1, tier 2. Yeah, so tier 1, tier 2 financial institutions, global banks. And then, I never had that perspective of how Wall Street worked, how the financial markets worked. It was just self-education through crypto because I was like, nothing makes sense. Nothing is connected. I need to do more research. And then as crypto blew up in 2022, I had the opportunity to jump over to a big 4 firm and consult with a team of 9 for global corporations through 2021 and currently. My key burning questions and reason why I took that opportunity was, I wanted to see if the crypto space was going to be adopted. Like, from my perspective, you're like everything you guys have said, seen, feel is how I felt. And I wanted to know, the old guard doesn't die like right away. They don't give up the kingdom. But I wanted to see if there was continued institutional adoption. And, that gave me a perspective where I was putting it on countries' balance sheets, opening up crypto native custodians, within different parts of the world, designing NFT strategies for global Fortune 500 companies, strategizing with tier 1, tier 2 financial institutions. And there's definitely a way that institutional money looks at, investments that differs from a retail investor. I think that education is important because you understand that they're looking for yield, right? They're looking for APY. And if they adopt something, then comes, the pushbacks from government, which we're seeing right now, but also comes the money for lobbyists, right? So in my perspective, governments use compliance regulation to slow it down. That's what they've been doing, but they can't kill it. And really, more institutionals will come out and say, they're in it with different strategies. And I think right now is, the greatest wealth transfer in history. And if you're on the right side of the trade and early, this is a really big opportunity for retail. Where, right now, people within the community, within the crypto space for the last 8 years have edge, right? They know how these networks work. They know what staking is. They know what lending is. They know the different cycles. Historically, it's mapping to 2013, 2014 cycle. They're using data analytics, AI. They're beating Wall Street right now. And then there's some hedge funds and some money that comes in, and their APY is crazy, and their ROI is crazy, and big institutions want to get in as well. But the next hurdle and the level of compliance that is needed for them to be able to diversify liquidity within to these markets is going to be the next phase. That's going to be like chapter 10, but it's coming.
So for the people that don't know what APY means, it's annual percentage yield. It's a percentage you get at the end of the year with the amount you invest, for the audience out there. So of course, you want to chase after high APY. So that's what institutions and people want. They want high APY. Of course, being fundamentally sound what you're putting it into.
Exactly. Yep. Yeah, and I mean, it's eye-opening, right? Like, you as a retail investor, if you're in this market, you felt fear of missing out. I think what was eye-opening to me was, Fortune 500 companies, institutions, countries feel that too. So it's amazing. The game theory is amazing within this space.
Yeah, Nish, you wanted to say something?
Yeah, I'd advise the audience to listen to what Graz just said again, because this is some insider stuff that is very helpful for you. Wink, wink. Yeah, lots of great insights. So we've been anticipating this crash, and I think this date, it was set at around 18th October, I believe, that they need to take some decision what to do about this debt. And I think, as usual, Mr. Joe Biden has raised the ceiling. So they are just delaying the inevitable. So what do you think will happen once this bubble pops? What will be the worldwide scenario? Will it be something like the 2008 economic crash, or something worse? Or what's your thinking? What's your prediction?
Yeah, Graz, do you think it's possible that that it'll happen, or they seem like they always find a way out? What's your opinion on that? Because I'm lost on that. They keep extending it.
The bankers have always got it easy.
Yeah, I mean, they arbitrage. So something called in the investment space is called risk management. Like, they take profits. They they go into, depending on where they are in the market cycle, where they think the risk is currently, using data analytics and metrics and risk management strategies. They've taken an investment and then, they put it into things that you will protect them. So, I mean, it's frustrating to see, like, for example, the housing market. Like, Patri, talk about what the average price of a house went up in Canada the last 2 years.
Okay. So let's give an example. My area, east side, Quebec area. Let's say we take, for the guys in the West, it's a 1-bedroom apartment, 1-bedroom condo. It was 6 years ago, it was around, let's say, I'm going to say 195,000. Or in the East, we call it the 3.5, 3 rooms and a bathroom. Now, today, checking, this 195 for the same bedroom, 1-bedroom condo is 325 to 350.
Exactly.
Whoa.
So the flight of capital is trying to find a house, right, that will protect its investment, its gains in the market. So you see, institutions, global investment arbitraging out of their country and buying up real estate around the globe. You have companies like this is kind of fucked up when you kind of research this, but essentially the Fed, U.S. government outsourced some of the investment operations to BlackRock. So BlackRock gets a division that invests on behalf of the Fed, which is kind of fucked up if you think about it, because they're a player in the market, one of the biggest players globally.
Shady shit.
But anyways, so one of the strategies they're doing currently in helping prop up the U.S. housing market is they're buying individual housing suburbs just in around the U.S. So, their requirements for their key requirements is to find safe assets to purchase on behalf of their clients and find APY and find yield generating operations, and that's moving into assets like housing, real estate. Right now from an individual retailer. So retailers, like individual retailers that are looking to buy their first house, it's almost impossible because you have stagnation in wage advantages, inflation and devaluing the purchasing power of the U.S. dollar, the highest housing prices because of the lowest rates currently, and then you're competing against institutional players on purchasing a house. So you kind of seeing, it's an unfair market, I guess you could say, in my eyes, when you're looking at it, if you don't know what's going on.
Personally, I think this is the time to buy as much gold and silver you can, because there is a lot of uncertainty. By the end of this year and the Q1 of the next year, it's going to be crazy. I think either we'll see a crazy crypto pump or we'll see a global crisis.
Yeah, I think you see both. Right, I mean, as everything gets, as money is cheap and trying to find a house, money is going from institutional players within the crypto markets as well, right? Don't get me wrong, we're in the last part of this cycle, and investment opportunities within the crypto space is crazy, right? And you have institutional capital flowing in from custody tech providers to DeFi providers, to NFT providers, to different platforms. And I don't see that slowing down, and that will help this market and ecosystem grow. I mean, I was frustrated when you kind of wake up because you realize that you didn't really know the vast rules of the game and the financial markets, but crypto definitely gives the individual the opportunity not only to learn, but also compete due to, this is the smartest, in this space, I've met the smartest people at all domains of life. It's like a group of polymaths, essentially. So you got mathematicians, cryptographers, security experts, traditional finance investment players. Like, you have this whole ecosystem that brings their own domain of knowledge, and you can learn something from everybody. And that's what I've tried to do and continue to do moving forward. And if you know where we are in the cycle currently, like, there's definitely ways to win and do well for yourself. And that's how markets have always worked, right? Crypto's not propped up by anything, and I think that's so cool. It's definitely manipulated like the stock market, don't get me wrong. Like, there's big whales, but there's no safety nets, right?
Yeah.
And with the higher risk comes the higher reward. And I think if you're educated in the space and willing to take some risk, there's some big returns that an individual player can get.
Yeah, I just wanted to add, like what Grad said, and what I like when I started, and I was in the same boat as you, Nish, is I was a little bit like not sure, because from my research and how the entities work, I'm like, is this a trap? But after understanding that this is new technology and coming to a sense that when the internet started, there was, of course, traps too, but that technology is what everything got built around on. So I applied the same analogy that if this is like the new technology, stuff is going to build around it. So I'm like, that was the moment, grads, that was the moment I clicked that that's where I just completely jumped from one side to the other, because I said, if this is the technology and stuff is going to be built around it. So I just completely shut off and did the switch. Like that day, I just said, fuck it, I'm in, and what I like about it,
because crypto is not just an asset class, it's an entire ecosystem that is getting built, and it only tends to get better.
Yeah, it is getting better. It's getting better. It's going exponential. And what I like about it, I like the idea that don't trust, verify. And I enjoy math. I used to be big on calculus and math. It's math. You cannot fuck with math. Math does not lie, So however it's built, it's mathematically sound. Nobody can fuck with it. So there's no corrupted individual. Okay, there's always those scam coins, or what you call them there. You have to be careful, of course. It would be, and you get rugged meaning you get pulled, you get stolen all your coins. But the fundamental BTC, Link, and ETH, the fundamentals, these three fundamentals, it's mathematically sound, good community, and nobody can change a code. No one, no idiot can come in and say, you know what, I don't like it, I'm gonna change the code. Nobody can do it. And since it's decentralized, they attack one vector, nothing will go down. The chain will just reject that attack. That's all I gotta say to add. My basic knowledge on that. And it's amazing. I really enjoy that mathematically sound code that cannot be tampered with. And it's like, I sleep well at night knowing that no one can do anything to it, and I am in full control, and I don't need anyone else. That's amazing. It brings back the manly virtues, I find, and it's just amazing. I find that's my opinion, the connection I find, and what I have, the relationship with it.
Yeah, custody of assets undoubtedly has to be the biggest plus point of crypto, the entire crypto space as a general. So you just mentioned about no idiot can change the code. But what if a group of people want to change, or rather don't want to change something, a proposal? I think something happened a few years ago, and now we have two versions of Bitcoin. We have the regular Bitcoin, the BTC as we know, and there's Bitcoin Satoshi value, right?
Oh,
so
yeah.
What's up with that?
When that happens, it's called a fork. You could do a soft fork or hard fork. I didn't go more deeper, but some people, like, let's say, don't agree with the way BTC is evolving, so they say, I'm gonna do a fork of it. So they made Satoshi coin. What is it called? I don't remember, but anyways, coin Satoshi coin.
Satoshi value.
Your Satoshi value. So they basically said, and correct me
Yeah.
on grads on this because I'm a newbie. They basically said, we don't agree with the way it's going, and we're gonna make a fork, and this is gonna be our way, and this is the code that we're gonna do it. So soft fork, I believe, is that, and a hard fork is when they update the protocol. But in order to update the protocol, for BTC, all miners have to agree, I believe. I think that's right. Correct me if I'm wrong on that.
No, that's right. I mean, I think it's really cool, right? Because it's true democracy. Like, if you are invested in a project, if you have built the community up, you've been involved. It's like, go read Block Size Wars, and that book that will detail. It's like a country revolution, right? Like, you have a split mindset, and then you vote. If there's a hard fork, you go down the path that you believe in, and you see where it ends up. But there's no going back after you choose which fork you go down. And it's fascinating to me because it's true democracy of community vote, right? So I don't know. I find it fascinating. Working in the cyberspace and security vectors, like, I won't go down this rabbit hole, but even the attack vectors and manipulation of, voting units is something that I think is being highlighted right now. But it's just really cool to be able to be an individual contributor within a project and have a say, a vote, and where it's going, and it's immutably recorded on the blockchain.
We recently had the EIP 1.5.9 update on Ethereum. So was it hard fork or soft fork?
I believe that was a hard fork. The EIP is a hard fork, isn't it? Yeah, because you can't reverse it. Everybody that stays on ETH.
Yeah.
And I didn't like, really, honestly, what they did with the EIP 1559. but it is stable. It is more stable, 100%. But the gas fees, by the way, for the audience on there, anytime you're in a chain, you have a gas fee. So the gas fee is, you use the initial...
Yeah, we'll get to that.
Okay. So I'll just say you have a gas fee. But I don't like what they did with the gas fees. But it is more stable, yes. And I'm hoping that E 2.0 will also address that issue. But we'll see.
The other interesting perspective, too, is...
Well, they promise that it will be consistent.
Yeah, I was just going to highlight just an additional point, is that the regulation has come out and vaguely indicated that Bitcoin and ETH were considered commodities from a taxation perspective. But I think if you took the fork going to ETH 2.0, I think that could be considered security. And I guess we'll see.
Jeez, it seems like they don't understand it either.
Yeah, they're not being. They're trying to slow it down, in my perspective. They're not being very articulate to the crypto native companies to make it easy for adoption, because it's happening too fast, right? Like, why would you want to give up?
Yeah, they can't keep up. That's what I find. They can't keep up, and it's hard to make a regulation when they can't keep up.
Yeah, and I mean, the crypto native companies are struggling with it, with the regulation clarity. I mean, even institutionals, which are pushing now, like Fidelity Investments just came out. I mean, they're pushing for an ETF right now, and it's been 3 years, or 2 years since they've been pushing that. And, regulation, clarity of regulation, not only in the US, but globally, is important for these institutions to be able to put capital within the market. That's definitely a big thing for them to be able to participate within the markets. And we want that, right? We're in. We want more money in here.
Well, also, that you bring a good point. Yeah, I just want to say, Nish, right away, like, you notice that these big entities, the bigger the entity is, the harder it is for them to adapt. It's like a big ship. It's harder to turn. So
yeah, it's like the Titanic.
Yeah.
Yeah.
Why do you think that Elon Musk pulled off from the scheme of You can buy Tesla with a Bitcoin. So apparently he said that there are some energy concerns, but I don't really find sense in it. What do you think is the reason?
I can't comment on that. Under NDA.
Okay.
Classified.
That's pretty diplomatic. Alright, we'll take it. So let's jump into a bit of a more core DeFi. So we talked about how amazing DeFi is, how stuff happens automatically. The lending, borrowing, staking, the gas fees and all that stuff. How everything is automated. So let's touch the topic of smart contracts. So as I understand, in the regular world, we have contracts which state some conditions. Once the conditions are fulfilled, the transactions happen. But these are based on third parties. There is some other entity that takes care that the transaction goes on smoothly. But smart contract is just the electronic version, the cryptic version of a regular contract. So there are conditions. Once the conditions are filled, the contract executes itself. And to that, you need to pay some gas fees. Is it right?
Yes. So, like I was saying before, whatever chain you're on, let's say you're on the BTC chain, you have a transaction fee or a gas fee that you have to pay. So it's a small amount depending on the. Some chains might be bigger, some chains might be smaller. It's just the way. The BTC chain or the Rookstock chain, which is a layer 2 on top of Bitcoin, is a small amount. Basically what it means is in order for the chain to do the transaction, you pay a small fee of the chain, like the BTC or the RBTC of the chain. For ETH, after EIP 5059, because of the stability, you pay, right now it's at 80 GUI. Right now, I'm checking it now on my computer, it's 80 GUI. We're talking, if you do a swap on Uniswap, it's 55 USD. So that's pretty high. But basically, it's a transaction fee. They call it a gas fee, but I look at it as a transaction fee to do a certain transaction on the chain. Now, when you go into a smart contract, you have to do this in order to engage in a smart contract, whatever it is, be it, yielding, staking, liquidity pool, such and such. So I'll stop there.
Yeah, well, for a smart contract, it is inevitable that you have to pay the gas fees because it is on chain. But when it comes to transactions, I think layer 2 solutions, the layer 2 scaling ones, it's pretty based. We can use that, of course, because it is off chain. So, well, before we get advanced into it, I'd let the grads explain what is layer 2 solution.
Yeah, so I mean, like Ethereum is like one of the most popular blockchain networks currently used. The fact that a total number of decentralized applications on ETH, I think there was like 2,000, 3,000 of them, with many more applications under development. So the potential of Ethereum boosting for decentralized finance space indicates possibly massive upsurge in the number of applications and users on the ETH network. So the continually rising number of users on the ETH network kind of has a certain limitation of the network. So looking at ETH layer 2 solutions come into picture when you're looking for scalability. So even if Ethereum is working on introducing kind of sharding as a feasible scaling solution for ETH 2.0, it's in development, as we're kind of seeing some of the layer 2 solution providers like Phantom, what are the other ones? Matic, and you're seeing ways to reduce the cost of transactions on that layer 1 network. So I just think of it as a way to reduce fees while scaling the overall ecosystem.
Yeah, I think the best example,
I think some of the most notable ones, like
Lightning Network. I love Lightning Network.
Yeah, can you talk about that? Because I haven't delved in it, to be honest. Like I don't like I'm on rootstock and just the normal BTC, but what's the Lightning? That's something I keep hearing, but I don't understand it at all.
Okay.
Nish, you want to take it or do you want?
Yeah, definitely. So, as you said, it is a layer 2 solution for Bitcoin, but it is optimized for transactions, regular transaction in Satoshis. So the most common wallet, it's called the wallet of Satoshi, I believe. So it's a mobile app, very easy to use. So what happens basically in Lightning Network is, so let's take three institutions, or well, three wallets. For example, there is Graz, Patricius, and myself. So you've loaded some Bitcoins in your wallet. So for example, your wallet now has 2 Bitcoins, Patricius. You send 1 Bitcoin to me. So what happens is, this transaction is not noted on the blockchain. This is off-chain. The Lightning Network takes note of this. Okay. So what's happening is, now my wallet is updated as 1 Bitcoin. Then again, if I spend this 1 Bitcoin and I send it to Graz. Now what has happened is, if you see the displacement, not the distance, the displacement, your Bitcoin out of your 2, 1 has gone from me to Graz. So at the end of the day, what's happening? Your 1 Bitcoin has gone from your wallet to Graz wallet, right? So after multiple transactions, we'll take the initial form. What is the initial condition of every wallet? The initial balance, and we'll take the final balance, and we'll balance it out with one single transaction on the blockchain. So instead of having every microtransaction noted on the blockchain, we are collecting them, right? So instead of going from point A to point B, noting on blockchain, point B to point C, noting on blockchain, we are going directly from point A to point C and then noting on blockchain.
Huh.
This is how basically Lightning Network works.
So it's the beginning and end result, basically. That's all.
Yeah.
Yeah, exactly.
Yeah, the Lightning Network is like the second layer added to Bitcoin's blockchain that allows for off-chain transactions. So transactions between parties that are not currently on the blockchain network. So multiple payment channels between parties or Bitcoin users make up that second layer. The Lightning Network channel is a 2-party transaction in which parties can make or receive payments from each other, and it enhances the scalability of blockchain applications by kind of managing those transactions outside of the blockchain mainnet, which is layer 1, while still benefiting from the mainnet's powerful transaction security paradigm. So how do we kind of explain this? A good metaphor I would say is to compare it to a bar tab. So you keep an open channel tab with somebody, like a bartender, and every time you interact or buy a beer, those Bitcoins are sent through the channel. Once you finish the transactions, you close the channel tab, and that interacts with the base layer of Bitcoin, sending it on to the on-chain wallet. And really the beauty of the Lightning Network is that even if you don't have a direct channel with somebody, you can find a path through other nodes, making it a number of hops to the final destination. Does that make sense?
Yes.
That makes sense. Okay.
This channel stuff is brilliant.
Yeah, so you have like Jack
That's
Mallers
cool.
and Strike. You have a lot of innovation taking place within this network today. They just recently integrated with Twitter for payments and tips. Jack Mallers has done great. You should follow Strike and read more up about them, but they're one of the primary players pushing this technology.
Hey, kudos to El Salvador, and hey, man, they're saving their country. That's amazing.
Definitely.
Yeah, that dude will either come out as the genius of the decade,
He
or maybe
deserves it, man.
Maybe if something goes wrong, I don't know.
We'll see.
He has taken a huge risk, that's for sure. That's some big balls move.
Yeah, definitely. I mean, he's forced competition and innovation within the space from different payment providers. If you look at Western Union and the amount of expenses incurred and the time it takes to send money cross border, I think it was like 3 to 5 days, right? With sometimes being 20% expense at the customer side, and now you have an instantaneous payment solution to send money across the world that interacts with the blockchain layer 1 mainnet in 3 to 5 seconds. So it forces the market to compete, right? In a space that these traditional players, giants, have stayed in due to compliance, due to different ways of looking at the current infrastructure they use to send transactions cross-border. It's amazing to see somebody so vocal about a transition for the self-sovereign individuals, giving back to the retail side, and what it will do and what it has done is not only forced innovation, but also improved productivity and reduced expenses. So it forces the incumbent, from a company perspective, to innovate, because he's essentially taking a huge part of that TAM of that company's business, that target addressable market. And that's what you're seeing all over in the crypto ecosystem.
Yeah, something to take note of is the huge MNC giants in El Salvador like Starbucks, McDonald's. These guys have started to accept Bitcoin as a payment method. And what's to stop them to implement this in other nations as well? So I think El Salvador has started a domino. It should have a domino effect ideally.
The way that El Salvador has legalized Bitcoin as legal tender, game theory again, right? We're seeing other countries doing the same thing, and like you said, it's a domino. So that looking at the way legally they've been able to implement this solution within their country, also kind of looks at the overall implementation of the central banking digital currencies and the current giants in that space within the IMF. So there's definitely political things going on as well, which when it comes to money and value, that will always be a thing, but it's definitely forced some country arbitrage right now.
I want to say something. Also, I wonder, because a lot of companies became zombie companies, that they're just going on like doing the same stuff and don't want to evolve anymore. They get free checks from the government and all that stuff. So if they don't innovate, they're going to be left behind and they're going to go bankrupt. I have a feeling some of them are going to end up doing that, because when when you're too comfortable and not evolving, they're going to have a hard time trying to evolve. Also, I want to say, like, the domino effect around the world, if the country and the leader really cares about their country, they're going to adopt and they're going to evolve because they want to save their people. I don't know.
Right.
There's going to be some countries left behind. I am guaranteed, man. I have a feeling. Maybe I'm wrong, but man, the shit I see of these leaders, I don't know.
I think it's the bigger countries that will be left behind in this race.
Which countries?
The bigger countries.
Yeah, because they keep their ideology of where we like the things, how we do our things, or nobody's gonna take us down. I'm like, dude, put your ego aside and fucking let's grow up. I'm talking French. That's amazing. Grant, did you understand what I said?
No, I only know my 4 sentences.
Okay.
Bonjour, je m'appelle Monty, comment tu? Je joue le hockey avec mon ami.
Ah, man, I gotta teach you. I gotta teach you. Anyways. So yeah, Nish, that's what I'm saying. Go ahead.
I was listening to a cool podcast the other day, and it was talking about economics and collapse of societies in the past, and doing kind of a historical review and analyzing, trying to provide insights. And usually the complexity of a society is a good thing. So problems lead to solutions, and those solutions present new problems, which lead to more solutions, which that's where value is created when you're solving problems. I think what's happening right now is that the crypto addresses some of the financial concerns, and it's done it in a very unique way using very innovative technologies that, the Web 2.0 was built upon, right? So I got my start originally in sales at a company called Cisco Systems. So I got a real paint by numbers education on the underlying infrastructure plumbing that made up the internet. And I see a lot of similarities of how the ecosystem of Web 3.0 technologies are building on top of protocols today. But one of the things that stands out in my head is you have the OSI model, the operating system of Web 2.0 technologies that interoperate with each other. So one of the unique things, looking at crypto, being in crypto, but thinking about where was the monetization, where was the best ROI from the Internet 2.0? It's companies like Cisco that, provided the routing protocols, the open interoperable protocols, where companies have built different application usage, data centers, databases on top of it. And one of the unique things that, I find similarities in is if you could own a routing protocol that, is built upon by service providers, you have the opportunity today. That is unbelievable in my eyes. You can own a piece of a protocol by participating within the network. Right now, when I see huge corporations that, looking at fundamentals, they value adoption of their networks. We're seeing the same thing happen in Web 3.0. One of the differences is if you look at Facebook, the original investors that own stock within that company are the ones that got provided the value of the adoption of that network. So if we think about us as individual contributors that were using a freemium service, which isn't free due to all the data that is scraped out of us and mined and sold to third parties for marketing purposes, what if you could own your activities? And that's something that's built upon Web 3.0. So behavior economics changes. The opportunities within this space, even though there's going to be a lot of regulation, there's going to be a lot of hurdles to get over, you have opportunities to change, behavior economics, economic models. So there's definitely, we're in this space, and it's in its infancy, but will continually expansively grow. But as an individual contributor, if you buy and participate in a network like Patrice has done over the last year in different ecosystems, he's getting paid for his activity, right?
That's fucking amazing.
Patrice?
Yeah, I like the protocols are amazing, and I'm in full control. I read, I understand what they're doing. And you helped me, Graz. Thanks. And Nish as well. And it's makes sense to me. And I'm why would I not participate in this for the future, for security and all the good stuff that comes with it? Why not?
Well, Graz, just for the clips of the podcast, can you quickly differentiate between Web 2.0 and Web 3.0 in simple terms?
Yeah, that's a good question. Yep.
In simple terms.
Yeah, you gotta help for me, the newbie, and for other newbies out there.
Yeah, I think looking at it, so do you guys understand the underlying hardware and software that makes up the internet today? Would you be familiar with a switch, a router, that is the plumbing, the pipes that are interconnected using routing protocols that make up the internet today? That's originally how Web 2.0 was built up, set up. It's interconnected routing protocols talking to each other. And that's so when I look at it, it's in the Internet 2.0, the interoperable players who were providing hardware to build the initial network up were the winners for the first 10 years. From like 2014 to today, we've seen software eat hardware solutions. So like virtualization, like companies like for example, you used to build out a data center. You would have physical servers. The company would stand it up. It had high operational and capital costs to keep and maintain it. And then you would deploy software from on-site solutions. Now we've moved to cloud, right? Like now software has been able to provide the same service, better flexibility at risk of security currently. But we've seen software eat all these hardware solutions within the market over the last 10 years. Now we're seeing SaaS platforms where it's like you don't have to purchase the hardware. You don't have to own and operate all the software. Like you just have a subscription service. And we've seen SaaS do really well and will continue to do well. I think the next iteration in this is individual contributors in a decentralized network providing these same platforms, these same applications. It's like now you have the blockchain, different blockchain layer ones. You have the different scaling solutions that are helping reduce transaction costs. You're having dApps being built on these blockchain platforms that interoperate with each other. You have interoperability between the blockchains. It's like all the same things are happening for a unique way to provide individual contributors that adopt early a token form of economics that, from my perspective is vastly more efficient to individual contributors. So, that's the difference I see. I would say software ate hardware, then software ate all hardware solutions, and the last thing it ate was money. And I think crypto addressed that.
So, from my point of view, would you say that software eats the hardware? Is like nowadays we don't connect to our computer, we connect to a cloud that has a desktop for us.
Yeah, it's just the evolution of the World Wide Web.
I see that at companies a lot.
In different networks.
That's true. Yeah, I see that, but I see that a lot happening nowadays. The companies tend to move on to, you don't have your personal computer, you just have a screen and a little transmitter device, and you connect to a server which has your stuff, which is the cloud. And they have this infrastructure somewhere in the world.
Yeah, so the evolution of the internet usage, as we know, it's been rapid and fertile. We are in an era where upgrades are deemed necessary in all facets of digital platforms. I think Web 3.0 is the answer to the decade-long question of finding a solution that represents back-end functionalities in addition to front-end capabilities that we indulge in on a daily basis. Kind of a read, write, execute web is what Web 3.0 is in simple terms. It's a solution where kind of data is not owned but shared in what is being termed as a semantic web. Web 3.0 kind of enables systems to create, share, and connect content via search, and artificial intelligence kind of powers web pages to understand the meaning of words. That's what natural language processing means. And so that instead of just recognizing keywords, I think Web 3.0 is much more than that, and I think we're witnessing it in a specific ecosystem.
Okay, so grads, the final episode for this part of the series. Exactly 1 year ago, or maybe around this range in last year, you gave us a price prediction for Bitcoin. It was $100,000 by the end of 2021. Do you still stand by it?
I think I called out in 2019 in the group. I called out 300.
Oh yeah, that was last year.
It was 300 to 500K. I think end of year 220K, is the average. Depend if we have blow off the top, maybe it's higher. The introduction of ETFs currently, I think announcements just came in the last couple of weeks here, or last week. I think that stands behind the credibility. Looking on-chain analytics today, the whales are taking off Bitcoin from exchanges. The analytics look good, so I would say 220K average in a year.
Wow. Crazy. So, all right, gentlemen, this wraps the first episode of the crypto series, because now we've laid the foundation for what is DeFi, what's wrong with the system, what is the future of DeFi. So in the next part of the series, we'll cover some more spicy stuff like NFTs. I love that stuff. Then I guess we'll delve into the different protocols. The different protocols Patri always mentions about his crazy returns. We'll talk about that. We'll talk about lending, borrowing, staking, everything that comes into core DeFi. So, thank you for tuning in. See you next week.
Thanks, Nish.
Thanks, Nish.
Thank you.